It's a fact of life that we're living in worsening economic times. I don't know if any of you read any of the papers, listened to the radio, or watched TV today, but if it, you know, I have a friend that suffers from clinical depression, and she said, I get up and I read the papers, and no wonder I'm depressed. And you really can't argue with that, right? So most incomes are going down for families and people, or sometimes they're just holding steady, but really generally things aren't too good. So it's really important now that everybody does everything they can to ensure some financial security as they go forward, especially in getting more secure financially and working on things like budget and saving and investing. So our speaker is going to talk about manageable savings plans and how to avoid fraudulent investment scams, how to create and adhere to a budget, and how to really plan for a financially secure future. First, we're going to start with David Dreyfus, who is with the Alliance for Financial Literacy. David?
Well, let me start by trying to explore with you very generally, what is financial literacy? What does it mean? What should it mean? What does it mean to me? It's really a state of mind. It's a state of mind wherein you begin to explore how you can become more fiscally responsible, more financially responsible, if you will, how you can better plan for your financial security and your financial futures, how you can better understand your risk tolerance in that environment, and how you can incorporate all of that to qualitatively lead a better life, both now and in the future. And how do you balance that? Because obviously we have to live now. So if we save everything now till later, we won't do a very good job using our disposable income to live. And at the same time, if we use everything now, we won't have much later. It is a universal concept. It transcends every demographic you can think about, every income level, every age, ethnicity, race, creed. It's universal. If you're 22 years old or if you're 62 years old, it's never too late or too early to start the process of becoming more aware, more proactive, and planning better for the way you live your lives today and the way you live it for the rest of your lives. Financial literacy has certain commonalities in the context of who we all are as people. Because the first commonality that it embraces is we're all different. So that's a similarity. The similarity is we're all different. Not one of the people walking this planet has the same fact pattern in terms of financial security or what they need to do to best plan for their lives. And there's a lot of reasons for that. Their income levels are different, their age is different, their expectations are different, their goals are different. So my goal may be very different from all of your goals in terms of how I want to lead my life today or how I want to lead it 20 years from now. So that's the first thing that one has to understand is we are all very, very different. So there is no cookie cutter, one size fits all for anything, which is what of course makes the process so daunting and complicated. Because what will work for me may not work for you, may be different for Senator Duane, etc. These are all differences and nuances that you have to understand. So it's a very personal thing. But there is a similarity in that, and the similarity, ironically enough, is we're all different. The other similarity is we will all experience change every single day. I just picked up the New York Post. Something's happening to me now or soon in the near future. My transit rates are going up. That's a change. I didn't vote or cause my transit rates to go up, but it's going to affect how I live because I use the transit systems. So my cost is going to go up. So the plan I thought about last week or the budget I crafted last week for myself that integrated a certain cost scenario for transportation is about to change. That's the point, the second point about financial literacy. You wake up every day and we all have this in common, we're a day older. So that's the first change we all experience. By the way, not all change is bad. We may wake up tomorrow and get a raise at work. We may get a promotion. We may hit the lottery. There are a lot of ways that change is positive. We may have a child, a grandchild. Our child may be getting married. So it's not all negative change, but it is change. And change continues to happen every single day. And that's why this concept is one you can never walk away from. Just when you think you have it perfect, just when you've integrated what you think is the perfect plan, something happens, and you have to revisit that plan and revisit it constantly. The other thing we all have in common is we all want to maximize our quality of life. We all want to make best use of the dollars we make, spend the dollars we have to spend most efficiently, and of course try and save something for the future. And then we'll continue to lead qualitatively better lives. And as the Senator alluded to, that is increasingly becoming a challenge for all of us. The second is we live in an age of globalization. Competition's higher, unemployment's rising, gas prices are going up. It's becoming harder and harder to maximize the use of our dollar, maximize the efficiency with which we expend the dollar, and really have something at the end of the day to save. So that's the second reason that we're out here trying to talk to you about these kinds of concepts. And the last thing is we're all subject to this, but unfortunately it's a reality. We live in a very much immediate gratification society. The next best SUV rolls off the assembly line, a TV comes off that we want, and our inclination as a society lately has been we buy it. And if we don't have the money to buy it, guess what? We buy it on credit. And if it's not good credit, it's bad credit. But we want that thing, so we go out and we stick our necks out. And then our necks are suddenly on a chopping block somewhere. And that's becoming it's increasingly a bigger and bigger problem. It's more and more dangerous as things become more and more expensive and it becomes harder and harder to manage our finances. The beginning point of financial literacy is really getting in touch with yourself. So it's very much a soul-searching process where you really have to look in the mirror and say, what do I want? How do I accomplish it with what I have? And how can I do certain things in the future? Now, the first thing I'm going to say is, I don't think you can do it alone. I think you're going to need help along the way. And I strongly, strongly urge, and there's a section in our handout about how you find the right professionals to help you. There may be many that ultimately help you. There may be specialists, financial planners, insurance planners. There may be accountants, attorneys, asset and income managers, long-term elder and healthcare specialists. The point is, there is so much information out there, and the industry has done such a good job of floating so many products. I mean, at the end of the day, I don't know where to begin. And if I don't know where to begin and I'm involved in the industry, people who are not involved in the industry certainly don't know where to begin. So my overall message, aside from being aware of this stuff and starting to take an interest in it, is at some point, please, please, please seek out qualified, competent, educated, ethical professionals of integrity. And we provide you with a list of some of the things you should start thinking about when you're looking for those professionals. One of the things you should be aware of when you are seeking someone like that out is you want to find people who are going to be with you for the long haul. People who put their clients' best interests first. People who are concerned with the totality of your life, who spend hours with you, searching with you what your goals are, what your expectations are, going through virtually everything you own, everything that you don't own, and really exploring that. And who don't have the hubris, the pride, and they're not afraid to say to you, you know, would you mind, I want to bring someone else in because I'm not really a healthcare specialist, or I'm not really a long-term care specialist. And then they bring others in for the purpose of really giving you assistance, and they form a team because they don't know it all either, but a team that actually acts as a check and balance between and amongst themselves, but B, ends up doing a better job comprehensively for you. So that's probably the overall message I have in terms of the generalizations. Now, how can I get a little more specific? To me, financial literacy, financial and insurance planning begins with creating that roadmap I alluded to. It really begins with exploring what you have in your world today, how you want to best live your lives today with what you have in your world today, and how can you in turn, by virtue of where you are, achieve things you may not yet have, goals and objectives in the long term. And creating that balancing act, quite frankly, on the scale where neither is mutually exclusive and one doesn't rob from the other. So that's very, very important, is you create that balance of life that I alluded to before. You don't want to do everything now and have nothing for later, and you don't want to have nothing now and then do everything for later. Neither is a healthy environment. Income and asset management is a big part of it. Long-term and retirement planning is another big part of it. And of course, the one we like to think about least, but again, it's another commonality we have, and that is confronting unexpected occurrences. Infirmity, disability, ultimately death, quite frankly, which we all share. We all probably at some point in our lives will become infirm. There's a 4 times greater chance we become prematurely disabled than actually prematurely deceased. And we certainly will ultimately reach the end where we pass away. But we don't want to think about any of that stuff. So in not thinking about it, we don't do any planning for it, and that's a mistake. So that's another big component of this, is to really confront all the contingencies. And by the way, they don't all focus around health. Your employer may walk in today's environment tomorrow and say, guess what, you're gainfully unemployed. Well, you have a certain lifestyle, you have a certain income stream. Your employer may have had disability benefits for you that are irrelevant. You're suddenly unemployed. How do you maintain an income level, an income stream, to get you over that hump? And there are state agencies that can help you, etc. But my point is, it's not all about health and infirmity or death. Sometimes it's about just other things, other stuff that happens that you didn't expect, that throws you a curve, but you want to at least anticipate it before it happens and try to best plan for it. Income and asset management. I'm a big proponent, and again, this all ties together with financial literacy. The first component to income and asset management is managing your income and your assets today and of course in the future. But the first component, I'm only going to allude to it, is know what you make. Know your salary, know your dividend income, your investment income, know the interest you earn in your bank account, know what you make. And also know what you own. Get an understanding and a familiarity about what you own. Real estate, stocks, bonds, just your employer package alone. What do you have there that's going to benefit you? And that's another slide that I include, company benefits. Understand, if you're involved with an employer, what they're giving you. Are they giving you benefits like disability and long-term care options? Are they creating a retirement scenario for you? Are they creating certain pre-tax deduction benefits for you, like MedFlex benefits and dependent care benefits and transit benefits, and of course the 401k and retirement benefits I alluded to, where you can actually take money before the government taxes it, put it into things that benefit you, and you don't pay tax dollars on it either now and sometimes ever if you spend it appropriately. Health savings accounts, all those sorts of things. But it's incumbent upon you, quite frankly, as the employee in a scenario if you are employed, to know what you have. Even if you have everything, even if you're involved with a very liberal employer, chances are you're going to need to supplement some of even what they give you. Understand whether they're giving it to you for free, which is not for free, it's part of your employment, meaning it's non-contributory, they pay for the whole thing themselves, and you just get the benefit, or is it contributory? They're asking you out of your own paycheck to pay certain monies every other week or every month, whatever, to fund your own health care. And that happens increasingly. Companies are passing those costs down the line back to their employees. But the first step is know what you have and scrutinize what you have. Read all your bank statements. Read everything that comes in the mail to you that's talking about what you have. Read your pay stub. Understand what's being taken out and where. What's going to FICA, what's going to state and federal tax, and what's going to the benefit packages you either have opted for or haven't, and what's available. Read your employer's personnel manual. All those kinds of things. I fast forwarded a bit, but some of my other suggestions are as rudimentary as create a budget for yourself, a budget for the week, a month, or a year. Now, if you don't keep your budget, you don't commit harikari either. A budget is a roadmap, it's a guideline, but it can help you because it helps you anticipate what your costs are going to be and match it up with the income you have, quite frankly. Income and assets, common do's and don'ts. Don't spend more than you make. Don't spend more than you make, right? I mean, it's a hard challenge. And the subsequent caveat to that is once we don't follow that credo, we go into debt. And when we go into debt, there's some good debt, and sometimes even in a plan, some good debt is good. For example, the right kind of mortgage, even in the subprime market we're in, but the right kind of mortgage results in certain tax benefits for you on your income taxes. So there's good debt too, so I don't want to create, there are no general rules here, and there's no blanket rules. But the point is, you have to worry about the fact, if you're living a life where you're constantly spending more than you're making, that should be a wake-up call to you. And then you're going into debt on credit cards and on home equity loans, etc., on and on. You're getting deeper and deeper into a hole. Don't fall for credit repair scams. There are generally no get-rich-quick schemes. Stay away from the friendly tips. And what else do I have here? Don't lend money unless you have it to burn. And no private investment. Someone comes along and says, I'm forming a company. And you're going to be on the ground floor. And all I need is X dollars, and someday it's going to be unless you have money to burn, I respectfully suggest it's a very, very dicey proposition. The other slide, what to look for in a financial professional. My biggest focus is make sure they're educated, make sure they come through referrals, ask them for referrals, confirm their referrals with the people they've referred to you, check with the relevant government agencies, and there are many of them, federal and state, to make sure that there are no pending or past claims against these individuals. Make sure they are constantly seeking out professional development and education in their own professional career. And by the way, as much as they want you as a client, you want them as a professional, so you have to do as much of a fact find with them as they should be doing with you. And you should not feel embarrassed about asking people who you want to put your ultimate trust in. What are they doing for themselves professionally? What do they do to train themselves ongoing? I don't care how sophisticated they become, how many degrees and designations they have. Those are all proper questions. And explore and research with the relevant government agencies about claims made and pending claims and all those sorts of things. If nothing else, let me summarize it this way. Be and stay informed. Be and stay aware. Be proactive. Never stop planning. 10% of life is what you do to it. 90% of our lives is how we react to it. It's a reactive process, unfortunately, where the world is operating around us and we have to react to it. Be cautious. Always use your sixth sense and your common sense. Trust it. It's good. It will serve you well. And I'm going to read you the final things, which are kind of the synopsis of what I've just said. Get organized. Know where your money is and where your money goes. Shop harder and smarter. Look at and know and understand your current debt and your future debt expectations and obligations and what you think you're going to be taking on. Work always to reduce your debt. Work always to reduce your debt in any plan. Work to build a stronger credit report. Again, there's a theme here. It's all revolving around debt and credit, etc. Save for the future. Set financial goals for yourself, both short-term and long-term, and understand them and revisit them often. They may change because life changes. Again, that whole concept of change. Create a spending plan, i.e. a budget, short range and long range, but week, a month, start with maybe a year. Invest money to reach your goals. The senator said that. I respectfully suggest that with everything you hear tonight, you're never going to reach your goals and objectives by sticking that cash in the mattress. You're never going to do it. Not in today's world with inflation and competition and oil at $4.50 a gallon and all that other stuff. And again, and the last thing I'll leave you with is the overriding point of my whole message. Contemplate change, contemplate unforeseen circumstances, and always invest your money not only to qualitatively improve your life in the future, but in contemplation of those changes and those unforeseen circumstances.
Today, I hope to talk to you briefly about a few things. First off, surviving the economic downturn. The senator alluded to the fact that we are in a particularly volatile situation economically. Long-term retirement planning, which is a strategy to surviving the economic downturn. We're also going to talk about two programs that we actively manage. One is the 529 College Savings Program. The other one is the Office of Unclaimed Funds, and we have representatives right up behind registration, and as the senator mentioned. And then I'll talk a little bit more about the Your Money New York initiative. That is an ongoing initiative, and it's going to have much more robust information moving forward. So basically, to kick off the surviving the economic downturn piece, I'm going to put some numbers, some recent numbers to what the senator had mentioned in his introduction and some of the things that David had talked about too, kind of put what's going on in perspective, and if nothing else, the numbers are really interesting to share at dinner parties and other opportunities. So numbers always make everybody sound smarter. So this is as of today. Gasoline in the New York City metropolitan area is $4.20 a gallon. That's up $1.12 since this exact time last year. Many of us may not drive. I'm not a driver myself here. However, the price of goods and services that we receive, particularly in our island, are affected by that. So that obviously that's going to have an impact. The last time numbers were available on credit card debt, this is a nationwide figure, was up 7% in May. That's up That brings outstanding credit card revolving debt to $961 billion. We are almost at $1 trillion of unsecured debt through credit cards as a country. Unemployment, something that the senator mentioned. Here's the number for it. It's at 5.5%, up almost a full percentage point from last year. And then some things that I'm sure we are feeling right now. Historically, food prices have risen at about 2.5%. It was 4% in 2007, and predictions at this point are 4.5% in 2008. And you can see some of our more commonly used goods. These numbers come from the USDA. And if anybody's interested in where the numbers are coming from, I'd be very happy to, afterwards we can talk through all those. Eggs up 25%, milk up 13%, poultry up 7%. In March, the monthly MetroCard went up $5. In front page of the paper today, we saw that we're going to get another 5% increase. I don't think it's been decided where it's going to be, if it's going to be base fare or how that's going to be distributed. But 5% in July '09, and then another 8% increase by, I believe, 2011 was the date we were given. And then the last factor, and this is something that our office looks at quite closely, we look at Wall Street performance. There might be a tendency to say, well, Wall Street makes tons of money, so who particularly cares if they lost $11.7 billion in 2007, and just in the first half of 2008, we're looking at $22.4 billion. Well, there's a tax issue for New York State. 20% of New York State tax revenues come from Wall Street, and 9% for the city. So that is an important factor for us, whether or not it impacts our lives directly. So some of the steps that when we look at these issues and we try to take what we look at a very macro scale for New York State and say, how can we take some very basic principles that we apply day to day and bring them into the realm of personal finance. One is pay down high interest debts. That sounds pretty obvious, but sometimes it's not always easy to do. High interest debts, let's start with credit cards. Let's start with that, us butting up against that $1 trillion. If you look at, as of today, the average credit card rate, and this is a non-reward card, is 12.32%. That is the average interest rate on a credit card. Especially right now, I challenge you to get that kind of return on anything. I mean, the stock market has historically returned 10.2%. So when you put it in that perspective, and yes, the credit card companies need to make money, they need to pay for their infrastructure, they need to pay for all of those wonderful services that they give us. 12.32%, that's rather high. A reward card, the average reward card is 14.30%. So, in a way, if you carry a balance and you have a reward card, chances are you are just paying for your rewards, which don't sound much like rewards at all. So, good rule of thumb, if you are in a situation right now where you're carrying a balance, perhaps you should call and maybe either get your card unaffiliated. A lot of people like to have their alma mater on their credit card, or those come with generally an increase in a fee. Not in all cases, but it's something to look for to see if you're paying a slightly higher rate simply because of a reward program that you may not necessarily be benefiting from, or some of the affiliations of those cards. So we recommend that you look into that. In general, if you take a 30-year mortgage, again, I'll put this in high interest debts. Generally, your mortgage is not a high interest debt, although there are some loans out there that we've seen that really do kind of skyrocket into that realm. One extra mortgage payment a year cuts more than 5 years off a 30-year mortgage. So if you can, a lot of people do it by taking 1/12 and adding that each of those to each month to make it not hurt as much, or some folks who have a bonus structure at work, take that one extra mortgage payment at the end of the year. That's something to think of. If I can pay down these debts, that's more money that I can keep, and heck, you can knock 5 years off a 30-year mortgage just for making one extra payment every year. One of the principles that we like to recommend to individuals is to pay yourself first. That's something that I think those in financial planners use all the time, and it's something that that is generally a good mantra. And I understand we have folks in the audience that are at a whole range of different financial circumstances, just like David mentioned. So on one level, and this may not pertain to you, but we recommend establish a banking relationship. In New York State, for those of you who use check cashers, or those of you who know somebody who uses a check casher, the approved rate, and every single check casher, just so you know, that does business in New York State has to be regulated by the New York State Banking Department. That is a state-regulated industry. Banking is a whole nother story. One bank may be regulated by the federal government, one bank may be regulated by the state. There's a whole bunch of different administrations on that front, but every single check casher is regulated here in New York State. Therefore, what they can charge is 1.75% of the face value of your check. Now, a $1,000 check, that's going to get you $17.50, and you can do the math out. So that's an expensive proposition simply for something that many banks offer to you for free checking. In New York State, we have a law, it's called the Basic Banking Law. The Basic Banking Law states that all banks are required to offer at least one. They have a whole host of accounts, as I'm sure those of you with banking relationships know, but they have to offer at least one account that has a $25 minimum to open, that there's no, you can maintain the account as long, even if the balance gets down as low as 1 penny, and that the maximum monthly fee on that account is $3. Sounds like a lot, okay, $36 a year for a basic, that's a savings account, it's a basic banking account, but when you look at that check casher fee, it adds up very quickly, especially depending on how much, so if you're trying to make a comparison between those two, that's something to consider. Kind of a next iteration, and this gets into individuals' comfort level, but I would strongly recommend considering, if you can, if you're comfortable with this, an online banking account. A quick analysis of the interest rates in New York City right now will show that they range from a low, this is on savings accounts, of 0.1% up to, I just did this a little bit ago, 3.47%. And I can tell you in the highest bracket of savings accounts, those are coming out of online banking accounts. There's going to be some limitations. You may not have access to a teller, you may not have, or you may not, depending on how they structure it, you may not have as frequent transactions, but generally a lot of the banks, because it saves them on infrastructure and overhead, and they usually classify them as direct, name of bank direct, and that's generally going to get you a higher interest rate. I also looked at what the kind of a span of all of the accounts here, an average in New York City, and I found that a third get you savings rates above 1%. And so the 2/3, we're talking below 1%, 0.1, 0.25. And when you think that there are higher interest options and something safe as a banking account, where they're all FDIC insured up to $100,000 for a single individual, you have an opportunity really to make those banks work for your business. This is a depositor's market right now. They want your deposits. So this is an opportunity to either, if you're comfortable with your bank, to engage them and talk about higher interest opportunities, or just to sever that relationship. Next step in terms of this economic downturn, look into retirement savings opportunities at work. There's been a whole host of information out there recently that shows that with some of the deferred compensation plans and 401ks, that a lot of companies, just to get people in, are now turning this into an opt-out system versus an opt-in, and that's having very good success for a lot of folks. Meaning when you start with an employer, you're just automatically in, and if you want to come out, you have to take the initiative to do that. Whereas in the past, they were finding that if you were required to opt in, that extra effort, that extra paperwork, a lot of people are saying, I don't know if I want to do that. And there's so many benefits involved in that. If nothing else, just the fact that a lot of that, just how much comes out pre-tax based on the limitations in the law. So that's opportunity for you to pay less taxes, and we do get into that, reduce your tax burden, while at the same time building a nice nest egg for retirement if your employer offers that. So I strongly recommend 457 plans, 403Bs if you work for a university, 401k as a private plan. Also, I would recommend going to the next one there, reducing your tax burden, and David got into this too. Look at these opportunities where you can set money aside in health savings accounts. Again, money coming out pre-tax. Dependent care accounts. It's a wonderful opportunity if you have a child and you are and have professional daycare services involved. You can set some of that money aside pre-tax. Again, lowers your tax burden. These are all legal ways to do it. 529 contributions, which I'll get into a little bit later. Education savings accounts, and then also transit check, again, which sounds even more relevant now, to put that money aside before it is taxed, and then you can use it for a benefit that you know you're going to be using anyway. The next one, and I'm going to get into that on another level too, this avoid fees. And we talked a bit about some of the fees involved. I guess it's technically interest on a check casher, but I want to give you some information on some of the fees that are currently out there. Particularly in regards to credit cards, that's something that we focused on quite a bit. The controller is actually working on working with the legislature to advance some legislation that's going to require even greater disclosure on credit cards, because there is a disparity in fees and interest rates that's out there. One thing I would say is, first off, with a credit card, to avoid fees, pay on time. The average late fee right now is $39 on credit cards. That adds up. If you look at the cash advance fees on average are 3% of the amount you advanced, plus the cash advance balance on average is received. So if you're carrying that balance, you're going to be charged on average an interest rate of 20% on that. And then finally, some very basic things like lifestyle changes. You know, just this July, for any of the smokers out here, you know already that how much a pack of cigarettes costs. I believe that a pack a day, when you kind of take the average cost in New York, it's about a $3,000 a year habit, and it's become that. That's something to consider. Again, this is a choice. We have to make choices. We have to figure out needs and wants and desires and things that are important to us, and maybe that is important. But at the same time, that is something that could change, and that is a high-cost item in many people's lives. Also, just in general, I put weight loss. We know from the Centers for Disease Control that obesity adds $4 billion annually to New York's Medicare costs, and just think of some of the other things that it might do for you personally. There are many places where it can add costs in your life as well. So something else to think about. This brings me into long-term retirement planning. As I mentioned, the controller is the sole trustee for the state's pension fund. Some of you in the audience may be beneficiaries of this pension fund. If you are, the pension fund is doing well. This has been a difficult year economically, but our fund consistently performs above other pension funds. So if there is any fear on that front, we are doing fine. Not as fine as we did last year, but we're doing fine. First off, we kind of took what we use, and we have a very sophisticated investment model where we're involved in a whole bunch of different instruments, but we believe that there are some basic principles that any of you, because we're going from savings, which is one concept, to investing. Investing is a way to get a higher return. I mentioned earlier, stocks returned historically since 1925 at 10.2%. So that's something to think about. Bonds, the historical return on bonds is 5.4%, and cash in general, historical returns is 3.8%. So these are, having a sense of the different investment opportunities that are out there, the first thing you need to know is what do you need for retirement, and you need to ask the right questions. I agree with David, there may come a time where you want a financial professional, someone who lives this day in and day out, but I think you really got to help yourself to be able to ask the right questions. And the controller's office, and I know members of the state legislature, are trying to give you the resources to get you there. There are a lot of organizations trying that as well. So knowing what you need for retirement, knowing how to kind of speak the language, know what the different things mean that you hear about in the paper all the time is going to help you make better decisions. Protect yourself with insurance. I couldn't agree with David more about not planning on the disability front, and a lot of people don't do that. So look into that, know what your coverage is. Come to next to take advantage of employer-sponsored plans. I mentioned that earlier. There's a lot of overlap in terms of surviving the downturn, but also just doing smart long-term retirement planning. There are tax advantages to deferred compensation, and there are opportunities for building a nest egg that you won't even know is necessarily coming out of your paycheck. You can work it almost perfectly, where the tax that is being that you're avoiding is it's almost like your net can almost stay the same if you play it right. So work with your HR representatives at work or your financial planner and figure out what's going to work for you. We talked also about avoiding taxes using tax-preferred individual accounts. Those are the health savings accounts. I'm also talking here about traditional IRAs, which your deduction comes out up front. Roth IRAs, where you're going to pay tax on that money now, but when you take it out when you're 59 and a half or older, then it's tax-free. And so there are other opportunities there. Minimize fees. One thing I would like to talk about briefly, and we've seen this because part of the pension fund is invested in just straight up index funds, which is really you go to you go to an investment company and you basically buy into like the S&P 500. That is the 500 of the top companies. That is their stock. You're buying into a share of that. Generally, the S&P 500 is a good indication of how the market in general is doing, and has historically risen. This is not a great time for the S&P 500. It's not a great time for the Dow Jones. It's a terrible time for Nasdaq. But over a long-term view, this generally rises. And what we've seen is that when we go passively, meaning just here is my money, index funds, I'm putting it in now and I'm coming back to it. Well, 50 years, we're a perpetual investor, so we can actually come back to this money 300 years from now, as long as New York is still a state and we're still a country and all those things. So we're going to find that generally, even our passive investments in an index fund are going to slightly outperform even some of the managed investments where you some of the 401k plans and others, there's an active management component. We've found that in many cases for us, the more actively managed funds, again, we're talking about mutual fund types of thing and broad kind of indices of stocks, we're getting a little bit of return just by being passive. And that's something that's accessible, provided we have some money that we're willing to invest. It's accessible to all of us. You can find opportunities for investing in index funds. So that's something to consider. Briefly, and there's tons of literature out there, the 529 college savings plan, when you set up an account, you can you receive New York State tax benefits up to $5,000 if you're single, $10,000 if you're married, and because of the way our tax code is written, it also has an impact on your New York City tax. Minimum contribution is $25, and the contributions grow tax-free, and they're not taxed when you take them out as long as they're used for qualifying expenses. A lot of individuals are scared that if I put it in for this one individual, what if they don't want to go to college? What if there's a whole range of uses. It's not just a traditional four-year college. And there's also the ability to change the beneficiary as well. Throughout the life, you can even change the beneficiary back to yourself if you want to go to college later in life, which many individuals are doing. So if you have any interest or any family members that are interested in higher education, it reduces your tax burden now and provides a good source of income for funding those benefits a little bit later. And I'd be happy to talk later about qualified expenses and some of the other things. I know there are a lot of questions on those accounts. There was one change to the legislation that the governor just signed in May, and that is, in the past, the only person who was allowed to contribute to the account was the actual account owner. So if I own an account for my daughter, I can contribute money. But if my father or somebody else wanted to contribute and they sent that check in, it was getting returned to them because it didn't come from me. So I would have had to have liquidated it, cashed it myself, and then moved that money. It was a difficult process, and a lot of people got frustrated with the system. So money that would have been invested in these accounts was just getting turned back, and forget it. I'll do something else. That system's ridiculous. So that logistical problem, which actually did have a big impact in participation, was recently changed. So that helps as well. Finally, our unclaimed funds office, and I would like to mention that unclaimed funds is not a good strategy for surviving the economic downturn. Okay? As the senator mentioned, the majority of accounts are for less than $100. And then finally, our Your Money New York initiative. This is an initiative that has been building. We consider this a piece of it because this is an important piece. This interacting and understanding what the needs and what the concerns are out there. Back in June, the controller conducted a statewide meeting of approximately 50 not-for-profit organizations to take their temperature, to see how we can best assist in this process from a state office. And this is going to grow. One of the big initiatives that folks want, they want a central location to know where certain financial opportunities through the New York State government are. And so that's whether it's HEAP on the home heating program, based on constituency, there are opportunities for veterans that specifically come from New York State. So there's a whole host of New York State financial type resources that we will be including in this broader initiative. So we look forward to building that into something very useful. It's in the process now. The website, it will quite simply, we already own the URL, so don't go out and try to buy it, and then for your financial strategy, try to then sell it back to us at a profit. But Your Money New York, spelled out, we have that URL. If you go there now, it's not launched, but we plan to be doing that in the fall. So, again, we're looking at a whole bunch of different options. I hope I covered a fair amount of what we're seeing from our vantage point, and I look forward to your questions and answers later. And I, again, thank the Senator for having this opportunity, so thank you.
As the senator said, perhaps I'm the bearer of, I'm the person that's here to scare you today. But unfortunately, you can't do all these wonderful things and that the other two speakers have told you about in terms of managing your money. If you lose it, if you become a victim of fraud, and hopefully that will not happen to you. And part of our goal is to educate you in the way that fraud works on. We think that the best prevention against fraud is an educated investor, and that's why I'm here today. When the victim discovers that they have been defrauded, and of course they usually do, but unfortunately it's almost always too late, because it's the nature of fraud that it sometimes does not become discovered until perhaps a year or 2 or 3, when you think you've made a great investment and then you can't get your money back. Unfortunately, sometimes by that time, the person who has sold you the investment is gone, the website is down, the telephone numbers have been discontinued, and as I said, and the office has disappeared. Unfortunately, our office is very familiar with that scenario. Sometimes we go visit what appears to be a prominent address, and frequently, by the way, on Wall Street or Park Avenue, Wall Street and Park Avenue, just filled with fraudsters, and they usually reach out to all across the nation. This is an industry that we export to all the other states. So, people hear from someone who has an address at 44 Wall Street, and that impresses them, and they have a fancy name or an old traditional sounding name like Hartford and McMurray, just making it up. But people, and by the time they say, well, I haven't been paid the dividends that I've been promised, the monthly dividends that I've been promised 4 months in a row, and they call the number that they were given for Hartford and McMurray. Hartford and McMurray doesn't exist. It's no longer there. Just as a definition, what is investment fraud? It's simple. It's stealing, cheating, and lying. It's lying to someone to get them to hand over their money for that person's personal gain. It's a very easy way of committing a crime. There's no violence involved. And as I said, usually these people disappear, and they're very hard to get at by the investors and, frankly, by government agencies such as ours, because frequently, we do our best to find them, but frequently they have disappeared. So therefore, as I said before, the best protection against fraud is an educated investor. Don't give people like that your money in the first place. What are warning signs of frauds? And I put this in terms of red flags that you should be aware of. High pressure sales tactics. Key phrases that you might hear. The price is low today. Buy when it's low, obviously. The deal is, this is a classic. The deal is only good for today. There's always, that's part of the high pressure, that whatever is being offered to you, it's not going to be there tomorrow. Well, let me tell you, that just isn't true. A legitimate investment is not going to disappear tomorrow. That's almost a sure sign that this is a scam. People who pressure you into making investments are not above insulting you. In fact, they thrive on insulting people. We have transcripts in our office of telephone calls that have been made to by people like this. Have you ever heard of boiler rooms, by the way? A boiler room is a place that hires a lot of unemployed actors and waiters, and they just joking about that. but but they could be. Anyway, they sit. They sit at long rows of desks with a telephone in front of them. You may even have seen the movie, by the way. It was quite accurate as far in the way it illustrated what a boiler room looks like. They sit at long rows of desks with a telephone in front of them. They are given scripts by their employer. They know exactly what to say. None of it is ad lib, and their job is to make as many phone calls as they possibly can in a day. And they may make hundreds of phone calls in one day, and they say the same thing all the time. And perhaps 90%, maybe 95% of the people turn them away and hang up on them, as they should. But if they get 1 in 100, and they're making 1,000 calls a week, and they get one sucker to buy whatever it is they're selling, they may have made a good commission for the week. So one of the things that and we have transcripts of some of the calls that these people make, and surprisingly, one of the things that they do is they insult. They're very proficient at insulting the person on the other end of the phone. Now, you would think that most people would say, forget it, and hang up. But no, the more the so-called victim resists, the more they may insult them, put them on the defensive, say, you don't know what you're doing, you're a fool. You have to talk to your spouse. What kind of a wimp are you? You can't make your own decisions. And these, frankly, as I say, it's quite stunning how much people will how much insult people will put up with and not hang up the phone, and sometimes make the investment. So that's what I mean. That's what's meant there when it says "Don't be a fool." That's what a swindler will say to a target, and it's a golden opportunity. These are just some of the phrases, as I say, that I've picked out. Okay, just some more warning signs. Promises of course. Promises of exorbitant profits. No one would be listening to them unless they could promise profits that are far above what you can get in your bank or from a legitimate mutual fund. There's certainly people would be hanging up. So they have to make it sound unbelievably good. If it sounds too good to be true, it probably is. It's one of our mantras as securities regulators. If it sounds too good to be true, it is. Guaranteed profits, there are no such things. There is no such thing as a guarantee in the business of investing. Claims of minimal risk or no risk, assurances that you can't go wrong, that's a sure tip that you are being conned. As I say, there is no such thing as a guarantee. Every investment has a risk. Even bank accounts have some risk. And of course, as was mentioned before, if you don't use an institution at all, and if you put your money in a mattress, that's also risky, because then that money won't be keeping up with inflation. But the higher the potential profits, and this is legitimate investments, the higher the potential profits, the higher the risks. The lower the risks, if you want low risks, then you're going to have to settle for small profits, small and steady. Evasive answers. Ask questions. If someone won't answer a question, that's a pretty good sign that they're not. If they're being evasive, unwilling to provide details and written information or to respond directly to an inquiry, that certainly is a red flag that maybe something is wrong with this investment. Well, I mentioned withholding written information. A swindler may say, it goes back to what I was saying before, that you have to do this today because this opportunity will not be available tomorrow. And going along with that, there's no time to provide you written information. You have to make a decision now. Slick brochures, glowing testimonials, and this goes to the issue of referrals. All referrals are not equal. Fancy names, as I mentioned before, and business addresses, or a nice website can also be part of a scam. Requesting your checking account or credit card number, don't give it. That's obvious. And this happens surprisingly frequently. Some of these people will actually offer to come by and pick up the money at your home. I would say that almost never a good sign. Almost never a good sign. And finally, the statement: just make out your check to me. Do not make personal loans to your broker or advisor. Sometimes there are established brokers, they're with established firms, but they have a business. They have a business on the side, and instead of advising you about investing in an investment account, they're getting you to invest in the little startup company that the XYZ company that they've started on the side. It's actually prohibited, but it happens. Promises of free trips or gifts, and finally, and this is very common today, watch out for the free lunch or free seminar, and they're very prominent today. The free lunch or the free seminar and the free steak dinner that goes with it. The steak dinner often isn't worth it because, frankly, these are not seminars where they're teaching you about the safe and wise investing. Almost always, these seminars involve the fact that they work for a particular firm and they're selling a product. That product may be legitimate. It may be legitimate. But the fact is, it may be totally unsuitable for you, and you should not be buying it in that environment. And I'll talk about that a little bit more. So types of scams. Scams can range from, and this is something very important that I want you to take note of. Scams can range from what I've been talking about, which is the outright intentional swindle, to a much more subtle deception by established professionals and firms. They can come in almost endless variety of forms, and almost anyone can become a victim. A swindle may involve a variety of products, usually sounding very complicated. It all comes back down to the same thing. If it's a con, it's a con. But the product names that are frequently used in connection with a con, as I say, they're complicated securities, and most average people should not be investing in them. Foreign currency trading, very, very, very risky, and you should really be educating yourself before you get involved in that, and you certainly shouldn't be going with someone who tells you you're going to be making a lot of money and trust me on it. It's nothing that you should trust anyone on. Commodities trading, similarly, options trading, prime bank instruments. These are names that are thrown over. These are words or constructs that are thrown around a lot. As far as I know, there's no such thing as a prime bank instrument, but they're sold all the time. It's a totally illusory product. Promissory notes, there are such things as promissory notes, but if they're sold, marketed and sold, it's almost always part of a fraudulent scheme. If they're marketed and sold on behalf of a company, almost always fraudulent. the businesses that that are supposedly stand behind the promissory notes frequently don't even exist. Viatical settlements, I don't know if you've heard about them. That is, and I know the senator has. Maybe we'll talk about it a little bit. But viatical settlements are very, very risky. And basically what it is, it's buying the life insurance policy of someone who's very ill or about to die. So it's really betting on their life expectancy. You buy that life insurance policy, that person dies, you come into the money that would have otherwise gone to that person. Again, it's a very risky business and really kind of an untoward business. I don't think you want to be betting on how long someone is going to live. Rare investment grade coins. New York is awash in this swindle, totally awash in it. There must be hundreds of firms and a lot of them are located for some reason in Long Island. We haven't been able to figure out why certain frauds tend to migrate to certain regions of the state. How to victim-proof yourself? Slow down. I can't say this enough. Just slow down. I think a lot of the fraud that we see could have been prevented if people had just slowed themselves down. As I said, remember that you're dealing with a salesperson. Understand the investment. Check. Check out their employment history, their disciplinary history, and any other information that you can get. Be wary of unsolicited offers. Do your own independent research. Review your account statements. And this is very important. And we have something in our office. Unfortunately, I don't have it with me, but if you call me, I will be happy to send it to you. It says here, take notes when dealing with the broker. And we've actually developed a notepad, which we usually give out at sessions like this, which is like a guideline of exactly what you should be asking, what information you should be receiving, and it's a checklist in effect. And you should make a record every time you speak to your broker, and you should keep it in your file. And we have such a checklist for you if you call our office.
All right, so let's thank all of our volunteers and staff members for picking stuff up. Don't forget to fill out your forms. Let's thank our presenters, please.